Okay, so hello guys. Welcome to the January session for 2026 advanced class. So first of all, the strategy that I trade all revolves around four key concepts. We have market structure, liquidity, point of interest, directional bias. These four concepts makes up the strategies that I trade. So we're going to take it slowly. And one thing I'll tell you guys is learn at the same pace that I'm teaching. There are some concepts that you may have been used to, which is not included in the strategy that I trade. So because it's not included, I don't expect people to start asking me questions about those concepts. For example, I don't use fair value gaps. I don't use there are some things I don't use. So when someone starts telling you, "Oh, what about fair value gaps?" It's not part of the strategy that I trade. Do you get? So just learn at the same pace as I teach. Everything that you need for this particular strategy to work for you, I'm going to go through it and I'm going to teach it well. So just learn at the same pace that I teach. Most people after the first session, they will start analyzing trades and start sending to you to tell them whether it's correct or not so they can take it. Meanwhile, we've not even gotten to the second session that explains the second POI that we use, or we've not even talked about different types of liquidity that can make sure you're not taking trades in a liquidity zone. We've not talked about directional bias, all those things. So just be calm to learn at the same pace as you're being taught. Do you guys understand? Can you hear me? Please, there's someone that his camera is on. You know your camera is on, please. Can you turn it off, please? So if you know you have your camera on, please turn it off. Okay. Okay. Okay, so we're going to, like I said, we're dealing with market structure, liquidity, points of interest, directional bias. So we're going to start with market structure first. Then we'll talk about liquidity. We'll introduce liquidity. We'll talk about one of the POIs that we'll make use of in this class. Then the next class, talk about the other POI that we'll make use of and talk about the rules of picking a proper point of interest. We'll talk about different types of liquidity and how we take our profits using those types of liquidity. Then finally, we'll talk about directional bias. So each class that we have, the question session for the class will be in the next class. So as we have this class now, the question session will be in the next class once we send the recording for the class. So once you watch the recordings and all, the class, that particular class and the next class that we'll have the question session for it. You can ask questions for when you're confused, for when you watch the recordings and map out the questions that you have. So after have this class, at the end of the class, I will send the recording to the group chat. Then you go through the recording, you learn and you map out the questions you have. Then the next class that we'll have after that class, both the questions for that particular class and this previous one, you just bring out your questions for when you're having difficulties in. And mind you, guys, I said this is not a beginner's class as well, it's an advanced class. So let's um let's get started. So hope you guys can hear me well. Am I free to start? Okay, good. So first of all, we're gonna talk about market structure. So what is market structure? Market structure is basically the current flow of the market, the current pattern or the flow that price uses to approach one level in the market or another. If price should move from this zone to this zone, the flow or the pattern in which markets used to approach this level to this level is what market structure is. Market moving from this level to this zone, the flow that price used to approach from that level to this level is what market structure is. So market structure is basically the current flow of the market, the pattern in which market used to approach one level in price or another. That is the definition of market structure. Now, there are three distinctive patterns in which market makes its movements. If you open up your charts, you always see price moving either this way, that way, or that way. It's always fixed. There's no way you open up your charts and market is not giving you either one of these moves. So the first one is categorized under trending markets, and the second one is categorized under ranging markets. So the first two under trending markets, you have the uptrend, then the downtrend. So the uptrend basically being when market is giving you a series of higher highs and higher lows. So if market is giving you a series of higher highs and higher lows, higher high and higher low. So each high that price will present presents will be higher than the previous one. So and each low will be higher than the previous one as well. So notice how this high and this high are not on the same level. This current one is higher than the previous one. And this low and this low is not also on the same level. Each low is low higher than the previous one. So this high and then this high won't also be on the same level as well. And the low here will also be higher than the previous one. This is what makes up an uptrend. So it's categorized under trending markets. It's one of the examples of trending markets that we have. One of the trending patterns we have. The first one is the uptrend. Then the second one is called what? A downtrend. That is when price is giving you a series of lower highs and lower lows, lower high and lower low, lower high and lower low, lower high and lower low. So notice each high will be lower than the previous one. Each next high that comes out will be lower than the previous one, and each low that comes out will take out the previous low. That is what makes up uh, a valid downtrend. And for the uptrend, each high that comes out will supersede the previous one, and each low that comes out will also be higher than the previous one. That is what makes up a valid uptrend. So the under the trending section of market structure, we have the uptrend and the downtrend. Then under the ranging side, we have what you call a consolidation or a ranging market. It's basically when price is not trending up and is not trending down, it's basically ranging, moving from your support level to your resistance level to support level to resistance to support. So this is what you call a ranging market. So if you check for the uptrend, if you use a line to draw out, you can draw that market is trending up because of how slanted the line will be, slanted to the upside. If you draw the downtrend, you can also tell that it's trending down because of how slanted the line will be to the downside. But if you try to do that for this ranging market, you can't really tell whether market is trending up or is trending down. Instead, what you will see is price moving in a horizontal pattern. Hope you guys are following me up. Okay, so these are the three ways or the three patterns that markets makes its movement with: the uptrend, the downtrend, and the ranging market. So there's no way you open up your charts that you wouldn't see market either trending to the upside, trending to the downside, or ranging. It's always fixed. Either price is what? Trending up, trending down, or ranging, or it's trending down, or it's trending up. So it's always fixed with these three movement patterns. It's fixed. So these are the three basic introductions to market structure, the three basic ways that price makes its movements. That's that's just the basic introduction to market structure. But when it comes to what we actually pay attention to, when wait, an example of the uptrend is this, downtrend is uptrend is this, downtrend is this. So it's very clear on the chart. The ranging market is something like this because you can't really tell whether it's moving up or down, but you can see it moving in a horizontal pattern. So that is just the basic introduction to market structure. What do we actually pay attention to when we're dealing with the structure part of our strategy? There are two concepts that we pay attention to when it comes to dealing with the structure part of this strategy. There are two concepts that we pay attention to. The first one is the concept of hang on, hang on guys. Alright, so like I said, under market structure, there are two concepts that we pay attention to when it comes to trading the structure part of our strategy. We already understand the patterns that price makes its movement with. That is just the basic one. But with these patterns, what do we actually expect from these patterns? Yes, we understand that when we're dealing with when we open up our charts, our focus should be whether to identify whether price is what's trending to the upside or to the downside or is ranging. We understand that. But once we spot these kind of things, what do we actually expect from these structures? There are two things we expect from it. The first one is what the concept of reversal, and the second one is the concept of continuations. What do I mean by this? So I said the first one is the concept of reversals, second one is the concept of continuations. What I mean by this is if you have markets trending to the upside, there are two possible scenarios that price can give you. Now, the first scenario is price can continue pushing back up. The second one, while at this level, price can start selling down. Same thing here. You have this clear downtrend. While at this level, there are only two possible scenarios here. Price can start pushing up or price can continue selling down. So if market is at this level and it continues to moving in the upside, that is the concept of continuation. But at this level, if price fails to still maintain the uptrend and starts selling to the downside, that is the concept of reversal. Same thing for this downtrend. At this level, if price continues selling to the downside, that is the concept of continuation. But if at this level, price starts buying to the upside and ends the downtrend, that is the concept of reversal. So that is why I said when it comes to market structure, yes, we have three distinct patterns. But what do we actually expect from these patterns is now where the concept of reversals, concept of continuations comes in play. Now, the reversal concept can be applied to only trending markets, but the continuation concept can be applied to both trending markets and ranging markets. Because for this ranging market, the only thing you can possibly actually trade here is if markets, for example, as it's ranging, it breaks out of one range. So let's say it breaks out of this range, then you can start towards trading in that new direction that the breakouts occur in, which you guys understand the concept of break and retest is something like this. Or it broke out from this range, then you start trading in this direction. So this is what the concept of continuation, basically trading in the current direction of the movement of the market. So the trending market, you can only use reversal concepts on, and you can also use continuation concept there, but you cannot apply reversal concepts to ranging markets. Hope you guys are following me up. Somebody shout power. All right, let's continue. So, like I was saying, we expect two things from structure. Once you've already identified the structure, to identify the structure part of your strategy, you need to know whether price is on the verge of giving you a reversal or whether price is on the verge of giving you a continuation. That would better allow you know whether you are looking for buys, whether you are looking for sales, or what to do next on the chart. So, what do we actually trade? How do we trade the concept of reversals and how do we trade the concept of continuations? Now, I would say this, we trade continuations more times than we trade reversals. Reversals are traded fewer times than we trade continuations. What do I mean by this? There are two possible scenarios where you can trade reversal concepts. This one is at the start of a new trend, and the second one is at the end of a current trend. For example, let's assume there are 2 points in price where market goes to. So let's assume price goes from here to this other side, here to this side, and here to this side. Now, when reversal concepts can come in play is when market gets to this level. Before it starts pushing to the other side, you will probably get a reversal concept here, which is telling you that price is about to change direction to the opposite side. Now, once market starts moving in this direction, if you're looking for more entries for the current direction of the market, you will be trading continuations. Let me make it something clear. Let's say at this level, before price started pushing to the upside, you will get a reversal concept somewhere around here. Now, after the reversal concept, if you're looking for more entries now to take the current direction of the market, you will now be trading continuations. You will no longer be looking for reversals. You'll most likely be trading continuations. The reversals will come fewer times than you trade continuations, but continuations, you trade it much more than you trade reversal concepts. Just like this, market was bearish, and you expect price to start buying from this level. When market was bearish, if you're looking for more sales to take for that bearish move, you'll be trading continuations as well, another continuation entry. Then when price gets to this level where you expect the buyer to come in, before the buy will happen, you will get a reversal concept here. Now, once you've gotten that reversal concept and the market is now currently bullish, if you're looking for more buy entries, you'll be trading continuations, continuations. So check, we've only traded reversal here, but we've traded continuations multiple times here and multiple times here as well. The only time you can look for probably another reversal concept is what? When price wants to change direction and stop buying and wants to start selling, you get another reversal concept here. Once you've gotten that reversal, so you check, we traded reversal continuations like 2 or 3 times here, reversal once, continuations like 3 times, reversal once. Then you start trading continuations again for the new downtrend of the market. Hope you guys are following on what I'm saying. Okay, okay, okay. Mhm. So what I'm trying to say is that the reversal concept we trade it few times, but the continuation concept we trade it more times. That's what we call, well, in directional bias classes, you understand why we trade reversals fewer times. And also, we don't just expect reversal to come anywhere. There are zones in the market where we actually expect these reversals to come in. Now, I want to give you guys a brief on directional bias. What I mean, like 'cause when I trade directional bias, I focus on trading directional bias in a trend-like pattern. What I mean by in a trend-like manner is I want to see price on an uptrend on the higher time frame for me to be overall bullish on the like on the lower time frames. Then I want to see market on a downtrend for a on the daily time frame as well for me to be bearish on the lower time frames, something like that. So like I trade in line with the current direction of the market. Now we already understand that the uptrend is made up of higher highs and higher lows. So on the daily time frame, if market is on an uptrend that is bullish, you'll probably likely be seeing some of this. Now this is what the daily time frame. Now, since this is the daily time frame, you're not going to be trading on a daily time frame, but daily time frame is just to get directions, directional bias to know whether you're looking for overall buys or overall sells. So if market is giving you this on a daily time frame, it's very obvious to say that market is what? Bullish. Now, because market is bullish, and you understand how trends work. After every impulse move, there will be a correction. If impulse move is what this push to the upside, the correction is this sell that will trigger another zone where another push to the upside will come. So the impulse move is the buy, the correction move is sell. The impulse move is the buy, the correction move is what? The sell. If it's a downtrend, The impulse move is the sell, correction move is the buy. Impulse move is the sell, correction move is the buy. Impulse move is the sell, correction move is the buy. So, but this one is what a downtrend. So when it comes to directional bias, I focus on. I'm just giving you guys a summary of directional bias before we teach the class, so you guys can understand what I mean by we trade reversals fewer times than we trade continuations. Now, the zones where we would actually be trading reversals for this market is this. Now, this place, now this zone, the market started giving you the correction from. You will probably trade reversal here. The reversal is what? To tell you that market is about to sell down to get to a zone where more buyers will come in. Now, our market is now selling to get to this zone. If you're looking for sales, you will be trading continuations, 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 continuations. When price gets to that level where you would expect another move to the upside to come in, you would expect another what? Reversal here. See, so while the reversal comes in, a market is now bullish. If you're looking for more buy entries for the current direction of the market, you'll now be trading what? Continuation entries, continuation entries, continuation entries, continuation entries, continuations. When market wants to reverse back again, so it can give a correction move, get another reversal here. When it comes to this zone, where you expect more push to the upside to come in, you get another reversal here as well. So that's why what I said, reversals, we trade reversals fewer times than we trade continuations. And where these zones we actually expect these reversals to come in, what are these zones? The zones are most likely higher time frame POIs. By higher time frame POIs, I mean a higher time frame order block or a higher time frame breaker block. Most of the time, it's mostly higher time frame breaker blocks because when price breaks out of a zone, it's more likely to retest to that zone first before more moves can happen in that direction. So, for example, as price broke out of this high, the external side of the high is where you expect price to come back to before you can expect more moves to the upside. The way that price broke out of this high as well, you would expect price to what? To come to that high before more moves to the upside can happen. So when market gets to these zones, these are the zones that you now expect a reversal concept to come in. So for example, on BTC, hope you guys are following me. I hope I'm not confusing you guys. Drop a little bit of power inside the comment section. Let's continue. Okay. You guys don't worry, even if you don't understand this thing now, we're going to still do directional buy as well. But what I'm just trying to give you guys is a brief of what I mean. On the daily time frame, there's always going to be a particular trend of the market. This is the daily time frame on BTC. Previously, you can see that it was selling. After a while, you can see that it started buying because you can see the uptrend. After a while, you can see that it started selling. The thing is just to identify the trend of the market by just shrinking your chart and seeing the pattern that price is currently moving at. If it's giving you lower highs and lower lows, you can tell that it's on a downtrend. If it's giving you higher highs and higher lows, you can tell that it's on an uptrend. If it's giving you lower highs and lower lows, it's on a downtrend. So it's very easy to spot because you already understand the pattern that price makes its movement with. When we talk about directional bias, this just is going to, I just want to fill you guys in on expect those MS reversals to come in. Now, what I mean by this is that if price should break this zone, I would expect market to what? To pull into the breaker zone. The breaker is the zone that price breaks. It's just like the concept of support and resistance. As price broke this zone, I would expect market to pull into this zone before more buys can happen. As price came here and broke this external zone as well, I would expect price to also pull into this zone before more buy can also happen. As price broke this, came up here, broke this high, and also broke this one, I would also expect price to pull into this zone before more buys can also happen. So it's just like this concept: high gets broken, a retest will happen. High gets broken, a retest will happen. High gets broken, a retest will happen. This kind of thing. So these zones now, these retest zones, is where you actually expect your reversal concepts to come in. So that's why I say we trade reversals fewer times because when price before price will get to these zones, it will probably take time. So while market has not yet given us the reversal concepts, we are most likely going to focus on trading continuations. If it's for the bearish side, if you check when price broke these zones, this external zone that was broken here, we expect price to pull into it before more sells. But I'm just trying to give you guys an instance of what I mean. I'm trying to give you guys an instance of what I mean, but there are zones we expect the reversals to come in. So the zones we expect the reversals now will now be this zone. The other one will be this zone. For this one, hope you guys are following what I'm teaching. Please, I hope I'm not confusing you guys. Is the network bad? Is network bad? Can you guys hear me? Okay. So the whole thing of what I'm trying to say is that there are zones we expect reversals to come in, and just to sum everything up, is higher time frame POIs, higher time frame order block, higher time frame breaker block. So before you can spot an MSS, there's going to be a zone where price will give you that MSS from. It's not just going to happen randomly. There has to be a zone. When we talk about directional bias, I will get deep into those zones and I'll explain how we trade all those zones. So I'm just trying to tell you guys that we trade reversals few times than we trade continuations. So let's go back to the topic. So now I want to mark out these zones that I'm expecting these reversals to come. So I marked out this first one. I marked out this one here as well. So there are zones you expect those reversals. Also in this scenario here, I marked out this one, this zone here. I will use all these things for example for you guys. Mark out this one. So let's go back to the normal time frames. So, like I was saying, we trade reversals fewer times than we trade continuations. So, what concept do we trade reversals with? We trade reversals with a concept we call a market structure shift. Some people call it change of character. Some people call it shift in market structure, but the general term is market structure shift. So, what is a market structure shift? The market structure sheet is defined as an indication that the current trend the market is on is ending, and the new trend is about to begin in its opposite direction. So what it means is that if market is trending to the upside and you get a market structure shift occurrence, price is about to start trending to the downside. And if market has been trending to the downside and you get a market structure shift occurrence, it means that price is about to start trending to the upside. So the first concept, the reversal concept, is treated with what we call a market structure shift. And the thing with market structure shift is that it's for reversals. And like I said, there are zones in the markets we expect the reversals to come in. If you see an MSS at a random zone, it's more likely not going to hold. You can see an MSS randomly somewhere and you think price is going to hold there. And then after you mark out everything, price is not going to respect you. You know why? Because you're marking out a structure shift at a zone where a reversal is not meant to come in. So that's why when I'm trading MSS, I make sure I'm trading at some zones where I know price actually intended a reversal to come in from, which I was higher time frame zones. Higher time frame zones are one of the zones you expect market to give you a reversal from. The second zone is POIs with an extremely large body. What I mean by that is, let's say you have an order block, but the order block candle is extremely large. And for example, I'll have an example here. This is an order block here. If you see this order block has an extremely large candle, which means your stop loss has to be extremely large. This kind of POIs actually give confirmations. The confirmations it gives is that price would give you a reversal concept while it taps into those POIs. So if it taps into this POI, there will be an extra layer of confirmation just to tell you that okay, price is about to start moving in in your direction. So the two zones I actually look for reversals from. The first one, higher time frame POIs, and the second one, POIs with an extremely large body. Or like just I don't know how to explore like other blocks that have a large enclosure, like a large body. I don't even know how to put it, but just pure another block that has a large body. That's what I can say. This is another block here, but it's just a short OB compared to this one that is extremely large. This would require an extra layer of confirmation. This one would not. Do you guys understand what I mean? I'll repeat myself again. There are two places where I expect a reversal concept to occur. The first place is a higher time frame point of interest. It can be a higher a day, by higher time frame I mean daily time frame. It can be a daily time frame order block. It can be a daily time frame breaker block. These two. I can expect market to give me a market structure shift when it taps into those daily zones. That's the first one. The second one is a POI that has a large enclosure, a large body. Those POIs, most times, price don't just move in once. When it taps into those POIs, they require an extra layer of confirmation when price taps into those large POIs, because most of the times, if not, you have to have an extremely large stop loss. Do you see? You have an extremely large stop loss. But when price taps into these zones, they give an extra layer of confirmations just to make sure that you can now like narrow your stop losses down and have a higher risk to reward ratio. So they give you an extra layer of confirmation by giving you a market structure shift occurrence. So now tell you that price is about to change directions to a new side. So these are the two scenarios where I can expect reversal concept to happen: the higher time frame POI getting tapped, or the POI with a large enclosure. So the reversal concept, like I said, can be identified with what we call a market structure shift. Now, a market structure shift is an indication that the current trend that market is on is ending and the new trend is about to begin in this opposite direction. Now, before you can get an MSS, price needs to have tapped into a zone where you actually expect the MSS to come from. This zone down here is the zone I marked on the daily time frame, that breaker block on the daily time frame that I marked. This zone here also is another daily time frame breaker that I also marked. If I go to daily time frame, you guys can see it that I marked this zone down here. I marked it and I marked this one as well. These two zones are the zones on daily time frame that I marked that price broke past and I marked as a breaker block. So if price taps into those zones, I can now go to the lower time frame and then look for the reversal concept. So now the reversal concept is called a market structure shift. And how do you identify a market structure shift? You identify a market structure shift when price deviates from the current pattern that makes up the particular trend it was previously on. For example, let's say this is the zone on the daily time frame that I marked out for price to touch before a reversal will come in. Before price will approach that zone, it will be on a downtrend, giving me what? A case of lower high and lower low, 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 lower. Then eventually, if it taps this zone, there are two possible scenarios that can happen where market taps into this zone. The first one is the zone fails. For the zone to fail, price will just continue what pushing to the downside. This will tell me that this zone has failed. But the second one that I actually expect price to give me here is what? For price to give me a market structure shift by what? Deviating from the pattern that makes up this previous downtrend. To deviate from the pattern, price needs to, instead of giving me another lower high, to continue pushing down, we'll take out this last high and close above it with a body candle. When this happens, then that means I've gotten a market structure shift occurrence. Somebody shout power. So the first thing first is before you can expect the reversal to come in, you have to mark out a zone that the reversal is actually meant to occur. Then when price comes there, you have to now wait for price to give you a market structure shift. To give you a market structure shift, price needs to deviate from the pattern that makes up that particular trend that it was previously on. A downtrend is lower highs and lower lows. For you to get an MSS, price needs to give you what? A higher high. If it's an uptrend, higher highs and higher lows. For you to get a market structure, the price needs to give you what? A lower low. So, so that is how you mark an MS. So if it's an MSS now to the downside, let's say you have a zone here that you expect price to sell from. Now, before price gets to this level, it will be on an uptrend because it's trending up higher high and higher low, higher high and higher low, higher high and higher low. Then let's say it triggers this zone where you actually expect the reversal to come in. There are two scenarios you can have here. The zone fails, then price will just continue pushing up. This means that the zone failed. Now, the second scenario is when it happens. Now, when price approaches this level, instead of making another higher low, so it can continue pushing up, it does something like this instead and takes out this last low and closes below that last low with a body candle. The moment this happens, then you've gotten a market structure shift occurrence. So, a market structure shift indicates a change in trend. It indicates a change in trend. So whenever you get an MSS at on some certain zones, it means to tell you that there's the formal trend that you have markets on is going to end soon, and then price is about to start moving in the opposite direction. So, and I like trading MSS in the direction of the market, overall direction of the market. For example, if market is bullish overall in daily time frame now, I would mark out a zone where price will sell down to before another MSS will come in to continue pushing market to the upside. So when market now comes down there and gives me the MSS to the upside, I can now trade it. So for example, let's talk about this first zone that I marked out here on the daily time frame. This is the zone right here. So before the price started approaching this zone, this was the high that price was on. Now, for example, this was the high, and you can see the market was on an uptrend. The only reason why I did not trade this sell is because this was at an all-time high. At an all-time high, you wouldn't really know the place that price will get to before it want to start reversing to the other side. It's not really that guaranteed, except maybe you are risking it at that point. But before price started selling, what did the market do? You can notice the change of the market structure shifts. It was on an uptrend, higher high and higher low, higher high and higher low, higher high and higher low. Now, instead of market continuing pushing up to go higher, what did it do? It came and took out the last low and closed below that low with a body candle. This signified a market structure shift. Now, this is what a risky trade to take. You know why? Because when this happened, there was no higher time frame zone where this reaction would have happened because this is an all-time high. So I can't really say that it's reacting from a daily time frame breaker or a daily time frame order block because there was no non-existent because it was at an all-time high. But even though the MSS still held and then price started selling after that, but the one I would actually trade from this move is this one down here because overall price was bullish and at the same time there was a zone on the daily time frame where I can actually expect reversals to come in. Do you guys understand what I'm trying to explain? What I'm trying to explain is that the MSS that triggered the sell, yes, it was valid, but I would have been skeptical to trade it because price was at an all-time high. At an all-time high, I wouldn't really know where to expect market to give me a reversal from. But this one that gave that price started buying from down here, it was easier for me to predict because there was a zone on the daily time frame where I actually expected a reversal to come in. So if market comes to those zones and now gives me an MSS, I can guarantee that that zone is going to hold because it has an extra layer of confluence to my trading. So now let's continue. So this is the zone I marked out on the daily time frame. Let's now see how the reversal will come in. So before price approached that zone, it was on a downtrend, giving us what a series of towards the end was you can see the lower high, you can see the lower low, lower high, 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 lower low. It touched that zone on a daily time frame. Two things that I can expect price to do here, but continue pushing to the downside like this and then violate that zone or give me an MSS. So the moment that price came, instead of making another lower high to continue pushing down to make a lower low, do that instead what did it took out the last high and closed above it with a body candle. This gave me a market structure shift. Somebody shout power. This here gave me a market structure shift. So the important thing to know is that before you can get an MSS, you have to have already planned a zone where that MSS will come from. It's only when market comes to that zone and then gives you the MSS that you can actually say that a reversal is about to come in place. So this is an example of it. So this is the first zone I marked out on that daily time frame. Let's go to the second zone. Second zone is here. Is here. Which is this daily time frame breaker as well. Here. So that daily time frame breaker there, that's the zone. So let's go to the chart and observe. So you can see price on a downtrend previously was selling. Towards the end, it can give us it was giving us a series of lower high, then lower low, lower high, then lower low, lower high, then lower low. You can see the word downtrend. So it was giving us lower highs and lower lows till it triggered the zone we actually were expecting a reversal to come in. When price triggered that zone, there are only two scenarios that can happen here. Price continuing the downtrend by what? For example, as I hit this zone, did this, hit this zone, it will just do this and then continue selling to the downside. That would mean that this zone is not going to hold. That is scenario A. Scenario B is price giving you an MSS while at this same level, you actually expected the MSS to come in. So when price hits this level and then pushed up and then took out the former high, the last high that price made, which is this high, took out the high and closed above that high with a body candle, we got a market structure shift occurrence right here. This is the second example. The third one is when I said when price hits a zone that has like an OB that has a large enclosure. This is the example of that OB. So price was on a downtrend and it was giving us what? A series of lower high and lower low, lower high and lower low, lower high and then lower low. It triggered that zone. So the only two things that can happen here: price can continue pushing to the downside, giving you lower highs and lower lows, meaning that this zone is not going to hold, or take out the last high that was made and give you an MSS. And the price chose scenario B, going to this zone and taking it out and closing above that zone with what? A body candle. Once this happens, we've gotten a market structure shift occurrence right here. Hope you guys are following me up. Can you all hear me? Even recently, you would see on BTC there was a buy that came in at a support level, which is this buy we have here. Before the buy came in, you can clearly see I think it's this, like I said, whenever price gets to a certain level, there will be an MSS occurrence. So it's this zone down here, this support level. When price hit this zone, it was on a downtrend, giving us a series of lower highs and lower lows, 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 lower highs, lower low, lower high, lower low, lower high, then lower low, lower high. It hits this zone. When price hit this zone, there are two things that we expect market to do. Either it continues pushing to the downside, or price gives you what? An MSS. That is what? A reversal concept. This is a recent BTC trade that just happened like yesterday or no, no, this is yeah, I think yesterday or Friday. I don't know. So when price hit this zone, what did they do? Instead of pushing to the downside and continuing selling, what did they do? It took out the last high and closed above the high with what? A body candle. So think I can mark out and I can mark this high, I can mark this high as well. So when price took out that high, instead of making a low that was, so remember, a downtrend is lower highs and lower, meaning that each low that comes out will be lower than the previous one. So when price did not give us a low that was lower than this previous one, for it to maintain the downtrend, it needs to have done something like this. But it didn't. Instead, it took out the last high and this high here as well. That means that the market structure shift just occurred. This is a recent BTC trade. Yeah. So just to tell you that there are zones we expect reversals to come in, zones that there's some other block zones. You don't just trade those zones if you have not seen a structure shift occurrence. If when price taps into this zone here, it taps into the other block zone first here, but it could not. If you took out this high, it would have been an MSS, but it did not. Instead, and the people that bought from here without getting that extra layer of confirmation would have what missed, would have gotten stopped out later on. It's only after price gives me the MSS that I can say, okay, price is about to change directions to the other side. Now remember, the confirmation is just for first time reversals. What I mean by first time reversals is price was obviously previously bearish. So before I get an MSS, the reversal has to come from a zone on the higher time frame. But if it's continuations, there's no need for those extra layer of confirmations. I feel like I'm getting ahead of the topic. When we are a directional bias, you will understand what I mean. For now, just know that to trade reversals, you need a market structure sheet, and to trade continuations, you need a break of structure. Hope you guys are following me. Sometimes I try to get ahead of myself and go too deep into the topic, but I remember that I've not gotten to that level with you guys yet. There's a lot of knowledge to be unpacked, so I'll take it one after the other. But what I'm just trying to explain to you guys is that before price can change directions from one side to another side, you need to get an MSS. That's what will tell you that okay, price about to change directions to the opposite side. Imagine price was bullish here before. Now before we started selling, the last low the market made was here before the high was made. Now when price hit this level, it started selling down, and when it was selling, it took out the last low and closed below it with this body candle. After this was made, It was after that that price actually started selling to the downside. And you see, so like I said, there are zones we expect the reversals to come in. There are zones we expect the reversals to come in. So when price hits those zones, let me check if this is writing from a zone. Let me check. I want to check if this cell is writing from a zone. Exactly. See, which zone is it writing from? Is this zone that price broke for this downtrend, which is it's even this OB here. So there are zones we actually expect these reversals to come in. It's only when price hits these zones, then give us that reversals that we can say that it's going to hold. Because when price hit that zone on a daily time frame, the reversal will come in. The reversal is what? A market structure shift. You need to get that reversal to now confirm that move to that direction is what's going to happen. So I already gave you guys an example of an MSS that is used to trade reversal concepts. Now I'm going to get to the one we use in trading continuation concepts. Hope you guys understood. So one thing you need to understand is that before you can look for an MSS, ensure that price hit a zone on the daily time frame. That zone, price needs to give you that MSS while at that zone. Or it can be an order block that has a large enclosure, but 80% of the time is always at a daily time frame POI. All right. So that is the concept of trading reversals. Now it's time to get to the concept of trading continuations. Now, continuation trade basically means you're looking for trades in the current direction of the market. If price is bullish, we're expecting to take trades to the upside. If price is bearish, we're expecting to take trades to the wall to the downside. That is basically what it means to trade a continuation trade. So, for example, and then you see continuations mostly after reversals have already occurred. For example, price was what? Bearish. If it hits a zone where a buy is meant to come in and you see a reversal concept happen there, after the reversal concept and market is now bullish, to find more buy entries, you would be looking for continuation entries, continuation entries, continuation entries. If price hits a zone where a sell is meant to come in and you get the reversal here, after the reversal, moving forward, if you're looking for more sells, you'll be trading what? Continuations, continuations, continuation. So continuation entries basically means you're looking for trades in the new or the current direction of the market. That's what it means to trade continuations. We are looking for trades in the current direction of the market. And we trade that more times than we trade continuations. Sorry, we trade continuations more times than we trade reversals. So now, what is the concept we trade continuations with? We trade continuations with what we call a break of structure. Now, a break of structure is a scenario where price keeps breaking key levels while maintaining the current pattern, the current trend. If market is bullish, for example, is going to be giving you a series of higher highs and higher lows. The key levels I'm talking about, let me define it again. A break of structure is a scenario where price keeps breaking key levels while maintaining its current trend. The key levels I'm talking about are the highs and lows in the market. For example, this uptrend that market just gave us, this high is a key level. So if price should give you a higher high while breaking this high, that means that a break of structure just occurred right here. So after every break of structure, market will give you a retracement into the direction where that break of structure came from. That retracement is an opportunity for you to jump in for more continuation buys. For if it's an up, so this high here is what another key level. If price should break this high, that means that a break of structure just occurred. After this, another retracement will come in place. That retracement will be an opportunity for you to what? Join in for more buys. So, unlike market structure shifts, Whenever you get a break of structure, whichever direction market is currently trading at, that is where you're going to still be taking your trades in. So if market is bullish and you get a break of structure, you're still going to maintain a bullish move. If market is bearish and you get a break of structure, you're still going to maintain what? A bearish trend. So, but if it's an MSS, this would be an example of an MSS. Then market does something like this. If something like this happens, that means that an MSS just occurred and price will start what? Selling very soon. So the difference between break of structure and MSS is that an MSS will reverse the direction of the market, but a break of structure will continue the current direction of the market. Do you guys understand what I mean? Now, the thing with break of structure is that when you get a random break of structure, it's very hard to pinpoint zones where reversals can actually come in. With this strategy, when you get a break of structure, it's hard to pinpoint zones where your continuations can actually come in because these retracements you marked here, you can be waiting for price to come to this zone or to this zone before you can continue your buy, and price will just come here and then start buying. Expect price to come here and price just go halfway and then continue buying again. So because of that, I don't just trade every break or structure that I see in the market. I trade what I call multiple or double break or structure. Why I call it double break or double break or structure is that when more than one zone is being taken out from the market, it's what you call a multiple break or structure. And why I say or double break or structure is that the minimum I need is just two. So as long as price takes out more than one zone, even if it's two, that can be a double break of structure. If it's three, it's a multiple break of structure. So anytime price takes out more than one zone, more than one high, more than one low, while maintaining the current trend of the market, that is an example of multiple break of structure. And I can trade that for my continuations. Because when those ones happen, price will more likely give you a retracement into actual POI zones for you to continue taking your buy or your sell. For example, let me give an example. I want to look for a proper example. Um, okay. This is an example of a break of structure right here. After this break of structure, this retracement that market made did not pull into any zone here where you can continue taking any buy. After this break of structure too, this one did not pull into any zone you can continue taking any buy. But there was retracement. But there was no zones that price will give you, like be like, okay, price put into this zone before more buys continue. Why that is because it's just a single break. So only one zone is being taken out, just this one high here, one high here, one high here. But if when we talk about multiple break of structure, now let's see the difference between that one and this one. Now, if you check, this is a break of structure here. But the difference here is that before price started buying back up, it's put into this zone. You can see this zone here. That's where price bought from. You can see again, this is the break of structure. Before price started buying, you can see the zone that they put into, which is this zone here. This is another break of structure. Before I started buying, you can see this zone that market put into, which is this zone here. Now, the difference between these ones here and this one that I was marking out before is that the first one I marked out are single breaks of structures. The ones I marked out here is double or multiple break of structure. By multiple or double break of structure, I mean when price takes out more than one high or more than one low. For example, this is what a break of structure is. Remember, break of structure is when market takes out highs or lows while maintaining the current trend of the market. This is what a downtrend. So every low that price takes out while maintaining this downtrend is a break of structure. But when market now takes out more than one low, that is what you call a double or multiple break of structure. Most likely an internal low and an external low, or an internal high and an external high if it's an uptrend. This is what I mean. Let's say there was a formal existing resistance level here, and let's even say another one here as well. Then price was on a downtrend before it eventually started buying. Now, what is buying is giving you what? Higher highs, higher low, higher high, higher low, higher high, higher low. Now, notice something. This ones that's giving you this higher, higher, and higher, and taking out just one high. The retracements are not actually pulling into zones where you can actually take continuations from. You can wait to take a buy here and price will snub you and keep moving up. But this one, you can see this former existing high here and this high here as well. If price should do something like this, take out this high, like this internal one, take out this high here and this one here as well. If market wants to give you a retracement before more buyers will come in, it will pull into a proper zone before another buy will continue. So out of all this brace of structure, I'm going to ignore this one, this one, this, and only trade this one that took out 1, 2, and 3 zones. So what I mean is that when it comes to trading break of structures, I ignore the ones that just takes out one zone and focus on the one that took out more than one zone. Hope you guys are following me up. Do you guys understand what I mean? Okay, let me explain again. This is a high. This is another high here. Then before the market now starts buying up, giving you higher high and higher low, higher high and higher low. When price took out this high, you can only just see one high that it took out. When it took out this other high, you can only see one high that it took out. When market takes out just one zone, is what you call a break of a single break of structure. Now, the single breaks of structure is more difficult to pick out zones where continuations can come in because most times price won't even give you a full retracement into those zones where your continuation buys can actually come in. Now, you see another one, another higher high, higher low, higher high, higher. I notice if now most people now, trust me, you would have kept your entry here, maybe for a buy or here for a buy. And because it's a single break of structure, price may end up snubbing that entry. Well, let's say something like this happens. Market gives you higher high and closes here. Now, what's the difference between this one that just happened and this previous one? This one took out this high, this other high here, and this high here as well. These previous ones that I've been marking out here since is what you call single break of structure. But this one that I just marked out here is what you call multiple break of structure because this took out more than one zone at once. Do you now understand what I mean? I know I'm coming. I'll show you guys the example on the chat. I'm coming. Just hang on. So let's hop onto the chat. Let me show you guys some chat examples. So in this one here, so the first ones I showed an example of single break of structure. Now I'm showing an example of double break of structure. Price already is on an uptrend, is bullish. So it means that each high that price breaks while maintaining this uptrend is a break of structure. So price would try to break this high, this single high here. Even if price broke this single high, is a single break of structure. Then you put down here. Then it broke what? This high. Well, not only did it break this high, you can also see another high here. And you can also see another high here as well. With this candle, price took out this high, this other high, and then this external high here, taking out more than 3 zones, more than 2 zones, 1, 2, and 3. This is an example of what? Multiple break of structure. Now, this move would give me a retracement into an actual zone, an actual POI before another buy will continue. Compared to the ones that will just break one zone, and it's difficult for you to mark out a zone where the continuations will come in. I don't know if you guys understand what I'm trying to say exactly. Let's go again. This is a break of structure because this low got taken out. This is another break of structure because this low got taken out. Now check. Most of you guys would have marked your entry here for a sell, but what did price do? Because this was a single break of structure, This pullback did not pull into this zone before the sell continued. This is another example of what a break of structure. Just this low got taken out. Now, most of you would have kept your entry here for what? More sells. But what the market do, it just retraced a bit here and then started selling again. You can't really see the zone it put into before it continues selling back. But it's a break of structure. Now, the only difference between this one and the other ones is that this particular one is a single break of structure because there's only one low that was taken out. So the pullback will not really be as clean as it would be if it was a double or multiple break of structure. Now let's go to the same break, but this one happens for like more than one zone. So this low here, and even this former existing support level here got taken out. Now, most of you guys will now keep your sell entry here. Now, notice how price gave us a full retracement into an actual zone before more sales started coming in. Why? Because the first one is a single break of structure, and the second one is a multiple or double break of structure. Do you guys understand what I'm trying to explain? So when it comes to trading continuations, focus on taking break of structures that break more than one zone. If it takes out one high and another high, you can trade it. But if it takes out just one high or just one low, ignore it. The one that takes out more than one zone would give you a nice entry for you to take your continuation. So now when you're dealing with break of structure, you have to ensure that you're looking for trades in the current direction of the market. If price is bullish, you'll be looking for buys to the upside. If it's bearish, you'll be looking for sells to the downside. That's the whole thing with break of structure. Whichever direction that the market is moving at, you will focus on taking trades in that direction. That is the difference between break of structure and the market structure shifts. Let's go to the chart again. I want to give you guys another example. So I gave you guys an example of an MSS here. That is a market structure shift right here for that says the market is about to start buying. Now after that, a market becomes bullish. If you're looking for more entries for a buy, you have to look for what? Break of structure. Now what that means is that you need to wait for price to take out more than one zone. Now this first move here to the upside broke just this high. What does that mean? I'm going to ignore this because it's just a single break of structure. Because most people will now keep their entries here and expect a buy to come in. What did the retracement do? Pew! Melaine, magic, never tapped into here. Why? Because it's just one zone that was taken out. Now, let's compare it with the other one that took out more than one zone. So this is what? Another zone here. And this is what? Another external zone. When price took out this high, I wouldn't call it a double break of structure because it's just one zone has been taken out here. Then another candle came out and then took out the second one. This is when it became a multiple break of structure. After this, notice how the retracement put into an actual zone before more buys continued. See the difference. See, this one I'm trying to explain to you guys. When trading continuations, when trading break of structure, how is my chart not showing? Do you guys see what the example I gave you guys just now? Okay. So, so yeah, so you guys understand what I'm trying to explain. When it comes to trading break of structure, ensure you trade the one that takes out more than one zone. Those are the ones that actually would most likely tap into your POI. Do you understand what I mean? Another example of a multiple break of structure. Now remember, While trading break of structure, you have to look for trades in the current direction of the market. So as market is bullish, you have to look for trades to the upside. And how do you spot the break of structure? Well, market takes out more than one zone. So in this move, market is bullish. And if for me to trade continuations, I have to look for price to take out more than one zone while maintaining the bullish move. So when price took out this high, the other high here, this other high here, it's still going, and it took out this other high here as well. Now, let's talk about the difference between this one that happened. This is a multiple break of structure. Then we'll talk about this one that happened here. This is a single break of structure, just one high. Notice how you would have marked your entry here or anywhere, and price just made a slight retracement and pushed up. And what did it do? Everywhere could just blow for your eye once. Now, and notice that difference between that one and then this one that took out this high, another high again, another external high, and another external high. What did this one do? Before it bought from this zone. It will pull into actual zones that you can keep it. Now, these zones, most of you guys are confused with these zones. This one that I just marked out, it's called a breaker block. I'll teach this particular POI in the next class. But I'm just giving you guys an instant that multiple breaker structures are more likely to tap into POIs than single breaker structures. I hope you guys, I know you guys don't know this before. But when market takes out more than one zone, it's more likely to tap into actual POIs than the ones that just takes out more than one zone. Just know this today. And that's why I don't trade the ones that take out just one zone. I only trade the ones that take out more than one zone. Hope that is clear. So I can move on to the next topic. Okay, so I want to do on sell. Okay, let's say on sell. This is a low. This is another low. This is another low. Price took out this low, and then this external low here, this former support level, and closed below all of them with a body candle. What that means is this is what a multiple break-off structure. I would trade this continuation here because price would actually give us a full retracement into an actual zones where sales can come in and say this is a breaker block, and then price put in there before more sales continue. So this compared to when market takes out just one zone, it's not like the one that takes out just one zone wouldn't really actually pull into a nice zone for you to take a sell continuation. So when you're dealing with continuations, you wait for price to take out more than one zone while maintaining the current trend of the market. So I've talked about market structure now for 1 hour. I've been talking about market structure for one good hour. I know why I've been talking for 1 hour plus. I've been talking about market structure. Started teaching around 9:20. It's 10:20 now. Talking about market structure. I want to make sure you guys understand it before I move on to the next topic. Hope you guys understand. If you don't understand, you have to watch the recording now because I have to come down to explain it well for you guys. For 1 hour now, I've been talking about just one subtopic, just to make sure that you guys understand it. W's in the chat. Exactly. So you guys understand sharp power. Let me join to the next topic, which is liquidity. All right. So now it's time to go to the to liquidity. So the structure part is just to know whether you're looking for sales or buys, because it's quite easy. Let me just give you guys a quiz. Let me just quiz you guys now. Just a quick quiz. So let's assume that you have a zone here. Then price is giving you what? Lower highs, lower low, lower high, lower low, lower high, lower low, lower high, lower low. Then price stops here and does something like this. When this happens, what are you expecting to trade here? Buy or sell? Exactly. So you see why the structure part is important. The structure part is important because you know whether you're looking for buy or sell. Now, let's go again. So let's say it completes and then starts buying. So this happens, then this happens, this high and this high getting broken. This is what MS is. Now, this particular one that happened here, what do you call it? One, two. What do you call this one that happened here? Exactly, multiple break of structure. With what direction am I still going to be looking for to trade? We've got a multiple break of structure. What direction am I still looking to? Exactly. So you see why structure is important. Structure is important because it tells you whether you are looking for buys or whether you're looking for sales. If the structure is not there, it's very difficult to know whether you're going to look for buys or whether you're going to look for sales. So when these things happen, you know, okay, the MSS means that a reversal is supposed to happen. I'm currently selling, and if it's going to be a reversal, it will be a buy. Okay, multiple break construction means that a continuation is going to happen. I'm currently selling. What is the continuation? And I got the multiple break of structure. I will still what sell. So that is why it's important to know structure. That was why I spent a good hour trying to teach you guys about market structure. So now that we're done with structure, we're going to move on to the next part, which is liquidity. Now, there are different types of liquidity that we have in the market, a lot of them. But there is only one that I focus on when it comes to picking entries. There are a lot of different types of liquids that we have in the markets, but I focus on one when it comes to picking entries, and it's called an inducement. An inducement is a type of liquidity that we use when it comes to picking our entries. And how do you spot an inducement? An inducement can be defined as the first valid pullback that you get after a market structure shift or after a multiple breakout structure. Let me define it again. An inducement is the first valid pullback that you get after a market structure shift or after a multiple break of structure. So it means that before you can start looking for inducement, you need to have first of all spotted a market structure shift, or you need to have first of all spotted a multiple break of structure. You know you cannot trade two structure types in one. You cannot be looking for MSS and be looking for double break of structure at the same time. You can only pick one. So if it's MSS that you see, you can look for inducement after the MSS. If it's multiple break of structure that you see, you can look for inducement after the multiple break of structure. So it's only one that you need between the two at a time. So you need one at a time. So what I'm trying to say is that the inducement is the first valid pullback. A pullback means a retracement. Let me use a diagram to explain what I mean. If you have a downtrend, lower high and lower low, lower high and lower low, lower high and lower low, lower high, then you get what? An MSS. After the MSS, it means that you have gotten the structure part of your strategy. After this, you should expect what? An inducement next. The inducement is what? The first valid pullback after the MSS. Now, there are two types of pullbacks or two types of retracements. The first one is a full retracement. By full retracement, I mean the one you will see a bearish candle that will close. The next candle will now come out bullish, and then before market will now push up again. This is like a full retracement that has both a bearish candle and a bullish candle. This is the first type of retracement. The second one is what you call a single candle retracement. Single candle retracement is what? The one that just has a candle wick, something like this: lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low, MSS. Now, first of all, the candle of that MSS needs to close first before you start looking for inducement. needs to close. So after closing, you will now see a pullback. Then once you see that pullback, before price would even close, it will just push immediately again. So this will just be a candle wick. Both this and both this can act as an inducement. Now, the most important thing to make sure is that the body closure of your MSS candle or the body closure of your multiple structure candle gets taken out by the inducement. What I mean by the body closure is that, let's say this is where the MSS stops, and then they say this is a candle wick, but this is where the body closed. Our focus will be, after we get this retracement, for market to push up and break off this body closure. The moment this body closure has been taken out, that's when you can mark that retracement as an inducement. Same thing here. This is the MSS. This is the body closure of the MSS. If market gives you that candlestick retracement and pushes up, our focus will be wherever the body closure of that MSS is, for the retracement that was made to take out that body closure. It's only after that body closure has been taken out that you can now mark the retracement that was made as your inducement. So let's go to the chart. I'll give you guys an example. So like I said, it can also be a single candle retracement. It can be a candle wick. It can be a single candle wick. Let's go to the chart. I'll give you guys the first example and I'll give you guys the second example. So this is what the example of the full retracement. After the MSS, the body candle of the MSS closure is here. This is the MSS candle closure. This is the body candle here. Our focus would be for price to give us a retracement that still proceeds to eventually take out that body closure. So the market gave us this bearish candle, then eventually the bullish candle that came up and then took out. When the moment this high got taken out, like this body closure got out, that's when this retracement can become an inducement. If price tried to, after making this low, it pushes up and did not take out this body closure and then came back down, any point of interest you have here, don't try and buy with it because it will not hold. Majority of the time, it will not hold. Our focus will be for the body closure of that MSS candle or the body closure of that multiple breaker structure candle to be taken out by the inducement. The body, not the wick. If our focus is not on, if the wick gets taken out, good and fine, but our focus will be for the body to be taken out. The moment price takes out the body here, this is the body, and close above the body, you can mark the retracement as your inducement. This is the full candle retracement here. Then this one is the single candle retracement. Now, this is remember, you only look for inducement when you've seen a multiple breakout structure or when you've seen a market structure shift. In this scenario, what we saw is a multiple breakout structure. After that, the body closure of that multiple breakout structure candle is right here. Now, remember, I said our focus is on the body closure. This is the wick, but we're not really paying attention to the wick. So our focus will be for price to give us a retracement that still proceeds to take out the body closure. Now, after that, the next candle that comes out after this candle closes gave us a retracement to the downside, which is this candle wick. And then it proceeded to now go up and take out the body closure and close above it. Once that happens, that's when you can say that you've gotten an inducement. This is your inducement. Here as well, this is what a multiple break-off structure. When this high, and this high got taken out, that's what a multiple break-off structure. While market is maintaining the uptrend, multiple breakout structure. After that, the body closure of that multiple breakout structure candle is here. This is the body closure. Up here is the wick. Our focus will be for price to give us a retracement that takes out this body closure. And even if it takes the wick, very fine. But if it does not take out the wick, but it closed above the body closure, that retracement can still be an inducement. So you can see this candle retracement here, this single candle wick is a proper inducement because when it gave us a retracement, it was able to go up and close above the body closure of this multiple breakout structure candle. So that means that this is an inducement. It's called a single candle inducement. So like I said, two examples of the retracement: the full retracement that has the bearish candle, and then we'll have the bullish candle as well. And then a single candle retracement that just has the candle wick. Hope you guys are following me up, please. Somebody shout power. Somebody shout power. So you don't understand the single candle retracements. Oof. Okay. Let me go back again. Single candle retracement is when you don't really see, for example, this is an example of a full retracement. Let's say this is an MSS, and then this is the closure of that MSS candle. A full retracement will have a bearish candle. The bearish candle will close. The bullish one will now come out to eventually now take out this high. This is a full retracement that has both the bearish candle and the bullish candle. A single candle retracement is something like this. After you've gotten the MSS, this recent BTC trade has it. After you've gotten the MSS, sorry, after you've gotten the MSS, which is here, this is the MSS. This is the body closure of the MSS candle. After that, the next candle that came out gave us a candle wick retracement. But immediately price gave us that candle wick retracement. It pushed up so fast and then took out the body closure of this MSS candle. So because the body closure of the MSS candle was taken out by that candle wick that gave us that retracement, the retracement can become an inducement. I don't know how else to explain it again. No. This is like the simplest way I can explain it. Our focus will be for any retracement that was made, whether it's a single candle or it's a full retracement. Once that retracement has been made and then price pushes back up again to take out the body closure of that candle that triggered the MSS. The moment that body closure of that candle that triggered the MSS closes, the retracement that was made becomes your inducement. Someone is asking where you can enter the trade from there. Calm down now. We're still going. Now, the inducement is just an extra layer of confluence to tell you that your MSS or your multiple break or structure is valid. Without an inducement, don't try and take a trade. There's only few scenarios where price will trigger a POI without giving you an inducement. Only few scenarios. So the inducement just acts like as an extra layer of confluence. After your MSS, if you get an inducement, it's giving you more confluence that that MSS you got is valid, or that double construction that you got is also valid. Now, is a trap also. An inducement is a trap. It lures traders into thinking that market is about to move at that level. So it acts as an extra layer of confluence. After the MSS and price gives you inducement, don't jump into the trade yet. Price will eventually come out to take out that inducement. It will take out the inducement. It must take out the inducement. So only after taking out the inducement that you can now enter the trade. But the inducement acts as an extra layer of security, an extra layer of confluence to tell you that the POI that you marked, sorry, that the MSS you got or the double option that you got is valid. That's what the inducement is there for. It's a trap. Is liquidity. Liquidity means zones that there's money in the market. So in an inducement is a type of liquidity. So, like I said, it can be a single candle retracement, it can be a full candle. It all depends on how volatile the market is at the moment. So, if market is extremely volatile, it does not really have enough time to give you a full candle retracement. It will just give you like a single candle retracement and then continue moving. But when it's just moving at an average speed, then it can give you that multiple candle inducement. So, another example, yeah, here the inducement, the single candle. This one is a full candle inducement. This one is what? Single candle inducement. Here is an MSS right here. After the MSS, the The body closure of the MSS candle is right here. The wick is up here. Our focus is not on the wick side. Our focus is at the body side. Our focus will be for price to give us a retracement that proceeds to take out the body closure, which is down here. So if market gives us the retracement and tries to take out this body side closure and it did not work, you will not mark your inducement yet until price eventually gives us the retracement that will now take out that body side. That's when you can now mark your inducement. So price give us what? In this, after this closure of this MSS candle, price give us this candle, even if it's the smallest wick, as long as there's a retrace, the wick there means that the price retraced in that direction before it continues pushing up. That's what they make a wick. Wick means price came down here and then pushed up. That's what a wick means. Came down here, then pushed up. So that retracement means that a pullback happened. So it can be a proper inducement as long as it takes out the body closure of the MSS candle or the body closure of the multiple break structure candle. So this is it here. So this is the body closure. So this next candle that comes out is a candle wick. And it took out the body closure and also took out the wick as well and closed above it, meaning that this candle retracement can be a proper inducement as well. So it means that you should only look out for inducements after you've seen your market structure shift or after you've seen your multiple structure. That's when you should look out for your inducement. So this one here for the multiple breaker structure. After that, the body closure of the multiple breaker structure candle is here. Now the next thing to look out for is your inducements, which means you should expect a retracement to the downside because price broke to the upside, so the retracements will be to the downside. That proceeds to now take out the body closure of that multiple breaker structure candle. The moment that body closure got taken and price closed above it, that's when I can now mark the retracement as my inducement. Even here, this high, this high, this high as well, even this high, they all got taken out and price closed above the high, all of them with a body candle, meaning that we got a multiple breakout structure. After that, the next thing to look out for is your inducement. The inducement is what? A retracement that takes out the body closure of the multiple breakout structure candle or the MSS candle. The multiple breakout structure candle is here, the body closure of it. So we should expect price to take it out after giving us an inducement. This candle that showed up next here, it took out the body closure, it took out the wick. But one thing is that it does not have an inducement, it does not have a candlestick retracement. There's no candle wick below it, so there's no proper inducement here. So we cannot mark out our inducement yet. Then price now, the next candle came out and gave us that retracement to the downside. After it gave us that retracement, price now pushed up to now take out this body closure. It's only after price did that and took out the body closure that I can now mark this external low that price gave us as my inducement. Hope you guys understand the concept of inducement now. The first example I gave down here, I want to also show you guys the inducement. So this is the MSS. The body closure of the MSS candle is right here. After that, we expect what? An inducement, a retracement. Now we got the retracement, but we did not get price taking out the body closure of the MSS candle. So we can't mark out an inducement yet because we have the retracement, but we don't have the other factor, which is price taking out the body closure of this. Then the next candle that came out gave us another retracement. Price did not still close above the body closure here, so we can't mark out an inducement yet. Then the next candle that came out now gave us that retracement, and then eventually the body closure of this MSS candle got taken out. It was only after that happens that I can now mark an inducement. So I can now mark out from any candle here and pick an inducement. So that is the whole concept of inducement. So even this recent trade on BTC, this buy that happened has the same thing. Has the MSS, has the inducement. So now that I've gotten the liquidity part of the strategy, it's now time to move on to the point of interest where we can actually get into the market. Now, there are two POIs that I pay attention to. There are 2 points of interest that I trade. The first one is an order block. Then the second one is basically a combination of breaker block, mitigation block, rejection, like all those blocks. I don't want to limit calling just a breaker because most times a breaker block, if you guys know what a breaker is something like this. This is what you call a breaker block. If market is on a downtrend, it takes out this low, then takes out this high. This is when it can become a breaker block. But if it does something like this, then this one is a mitigation block. So I don't want to, I only know this because I studied it sometime, but I don't want to limit it to calling it just a breaker block because all these blocks can work. So it's somehow to just generalize and call it a breaker. So I don't know what to call it. So I'll just call it failed zones. Failed zones, other blocks, and then failed zones. Why I call them failed zones is because price breaks past them. When price breaks any zone, the body of that zone becomes becomes a POI. For example, has market broke this high now becomes a POI. It means that a retest to this zone can allow market continue moving to the upside. As market broke this high, a retest to this zone can allow market moving to the upside again. So to generalize and call it a breaker is not actually fair. So you can just call them failed zones, failed order blocks, because they mostly have the shapes of order blocks. So as market broke this high now, for example, this is a failed zone. This can be a POI. This is a failed zone. This can be a POI. This is a failed zone. This can be a POI. Just that for you to not pick your entry, there are rules that we have that will enable us know the one to use between all of them. So, for example, if market should do something like this, lower high, lower low, 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 then you get an MSS. When market gave us this MSS, you see these zones that price broke, this high and then this high. They are failed zones that price failed to hold from. Market broke them, so they are failed zones. All these zones can be used to buy the market back. So this market can buy from here, or market can also buy from here as well, or it can buy from the other block. So you can only pick one, but there are rules that we check before we can pick the POI between all these zones. So it's not yet time to get into it. I'm just trying to give you guys an instance that we don't just use the other block when it comes to picking our entries. We also pay attention to these zones as well. But in the next class, that's when I can actually talk about these zones and then give you guys a proper example of how we trade these zones. Hope you guys understand what I'm trying to say. What is saying let's close for today? I don't understand. If you're tired, please now exit the class. Oh, wow. So, but we're at the last part. This PUI part is the last part, actually. This PUI part is the last part. I just want to give you guys the PUI. So the PUI that we're going to talk about in this class is the other block. And the other PUI we'll talk about is in the next class. And the rules of picking a point of interest will also be in the next class. Now me they talk for 2 hours. Now another person they talk say they exhausted. I've been talking for 2 hours. Now you they exhausted. No Allah. Now myself I blame. Let me want teaching. So now it's time to talk about the other block. Now the first the order block. An order block is defined as a zone in the market where there are a lot of institutional orders. So the zone in the market where you have the institutions, the banks, the hedge funds, the zones they place their limit orders. That's what your order block is. And then they have specific shapes. So we have two types of order blocks. We have the bullish order block and then the bearish order block. So the bullish order block is this: the market gives you a bearish candle, then gives you a bullish candle that engulfs it. When that happens, this is a bullish order block. So if you have to pick your entry, and this can be used for when you're looking for buys. So when you're looking for your entry, you put your entry at the demarcation, the middle of it here. So the buy will come from here, then your stop loss will be below the candles there. And then there's the wick in your order block. There's a candle wick. For example, if you have a candle wick here, if the wick of the other block is small and smaller than the body of the other block, you pick your entry from the wick of the other block here. If the wick of the other block is extremely long and longer than the body, pick your entry from the body of the other block here. Same thing for sell order blocks. The sell order block, you see a bullish candle and a bearish candle that engulfs it. Now, if you want to pick your entry from the demarcation here, and your stop loss should cover above the other block candle. So if there's the candle wick at the entry side as well, if the wick of the other block is small, pick your entry from the wick. If the wick is extremely long, longer than the body, pick your entry from the body. If you also have wicks at the stop loss side, make sure that your stop loss covers those wicks, because most times price can be tricky and then go close to those wick side. So if you have a wick at the stop loss side, cover the stop loss side. So it's now time to fuse everything together. So you've gotten the structure part, the MSS or the double break of structure, gotten your inducement. Then you have to now, for this scenario, look for your order block that is after the inducement. So once the inducement gets taken out, you mark out your order block. So for this trade here, our inducement is right here. Our order block is down here. Now this order block is a bit confusing, so I would actually scale to different time frames to see if I can see a better order block. Because if your POI is not really that clear on the time frame that you're on, you can scale down or scale up to look for another one. So yeah, I think it's a bit clearer here. Yeah, it's a bit clearer here. So the moment price takes out your inducement, it's going to trigger that order block. This is where your buy will come from. Now, if I was one that was taking this trade, my stop loss would naturally be here, would be here. I have experience trading this kind of OBs, but why I say you guys should cover your stop loss side is because most of you guys don't have that experience yet. So just to be safe, cover it. But it will reduce your risk to reward. But me trading it will keep my stop loss here because I already understand how this kind of order blocks work. But so let's move on to the other examples. So you get your structure part, you get your inducement, then you mark out the other block that is closest to the inducement. That's because we are dealing with other blocks now. When we talk about the other POIs, I would now generalize all the points of interest that you can use. So this is not want to load. I want to go you guys the other example. Okay, yeah, here. So in this one, mark out the MSS, mark out the inducement, then look for the other block that is close to the inducement. So this is the other block, the bearish candle, the bullish candle that engulfs it. This is the other block here. So because the candle of the other block, the wick is smaller than the body, I'll pick my entry from the wick. So this is where the buy would come from. So the moment price takes out the inducement, it will go to the other block that is closest to the inducement. That is what the inducement is for. The POI closest to it is where your entry would be. So this is the buy here. This is the buy for the MSS. Then the buy for the multiple break structure is here. So after this is well, this is the other block closest to it. Because the candle wick is smaller than the body, pick your entry from the week of the other block. This is the buy. Someone was asking me about time frames. Do you guys notice that I switched from the 30 minutes time frame, from the 1 hour time frame to the 30 minutes time frame, and somehow all my POIs are still aligned? This is the 30 minutes. If I go to the 1 hour time frame, I will still have the same POI. Just that the other one may be a bit lower, this one, but you still get your POI correct. So the time frame does not matter. I was on the 1 hour time frame before. I'm on the 30 minutes time frame. I was at the point to see the right same POI. So that POI. The only thing is that on this 1 hour time frame, you would have kept your entry here, but it's still like it was just slight peep difference, but you still catch the trade. You understand? Here, same thing. You marked out your multiple block of structure inducement. You look for the other block that is closest to the inducement, which is here. The small, the candle is smaller than the body of the other block. So you mark your entry from the candle wick. So once price sweeps the inducement, we go to the other block that is closest to the inducement, which is what's here. And then if I've taught you guys breaker blocks, I would have taught you guys that price can actually as well react from this breaker block here because the breaker and the other block are on the same line. But I've not taught breakers, so that's why I'm just using the other block candle here. So this is the buy. Now this multi-breaker structure inducement, the other block is here. Price never go to this other block. There's a reason why, because I said we have rules of picking a point of interest. It bought from here instead. That's because this one is the one that obeys the rules of picking a point of interest, not the other block. So when we get to those other POIs, we can talk about the rules well. This one, MSS inducement, the price would eventually come and take out your inducement, then go to the other block that is closest to it. So this is the other block here. The candle wick is smaller than the body, so you're marking an entry from the wick. This is where your entry will be. Stop loss will cover the other block candle. So that's just the introduction to that is just the introduction to this strategy. That is the introduction to this strategy. So we'll talk about, do I say limit orders? Anything I want to do, I will do now. If you want to say limit orders, you say limit orders. If you want to enter at market price, when price comes there, you enter when price comes there. It all depends on you. So I've actually been on teaching for 2 hours. I'm done with this particular session. The next session that we'll have will be on this is the introduction now. We have not even talked about the other POI. We've not even talked about the different types of liquidity. When I tell people that it's 4 sessions, they think it's just small ball. This is knowledge impacted, compressed into 4 sessions. No, multiple knowledge compressed into 4. They don't understand until they join. But we should talk about take profit levels as well. That's why people don't understand. This is full knowledge broken down, compressed into 4 sections. So, and the risk to reward is actually very, very high. The risk to reward ratio is very high. The smallest risk to reward you can see here is 1:5. I do 1:10 easily. Like it's very easy. As I placed my entry and then put my TP at this high, this trade is 1:9. Place my entry, put my TP at this high. This trade is 1:13. And I'm not trying to hide, like I'm not trying to decrease my stop loss. My stop loss is covering this candle wick of this stop loss. It's actually where it's supposed to be. The next high is 1:13 risk to reward ratio. This trade, the high that I targeted for my trade is 1:12. Even if I say let me reduce it down to this high here is 1:5. And it's just the smallest one, this candle here, 1:5. Like people don't understand how the risk reward works for this particular strategy. This trade, the stop loss is covered well. If I say let me target just this high here, that's 1:5. Just to be stingy and let me just put it here. Let me target this high here, 1:9. And I will say to you guys, take profit levels. So you guys can even understand where to actually place your take profits to actually maximize your risk to reward ratios. But that will be on the like the third class. This is just an introduction to the strategy. Do you get? So uh guys, it will be on the so I'll drop the recording once it's done processing. Let me rest a bit. And I'll see you guys in the next class.